If you deal with overseas or foreign suppliers that you need to pay in a foreign currency, US dollars, euro, yen, whatever it happens to be, then the important closure to the actual transaction is physically paying the supplier themselves. With Visage, that's a fairly simple and streamlined process. Procedurally or navigationally, to do this, you'd go to the accounts payable system, we'd go to transactions, and specifically we'd go to the overseas drafts menu. Now the first item on here is an overseas cash requirements report. This is very similar to the cash requirements report that we've looked at previously for paying domestic suppliers, and effectively it allows us to get a report out of the system showing us what we would need to pay based on selection criteria we nominate in the report. Now, exactly the same as the domestic suppliers, we first of all get to nominate if we want to show current vouchers. These are vouchers that are due right now, or not necessarily now, due at whatever date we wish to nominate here. So we might be interested in everything that's due up until the 20th of April. It's unlikely that your overseas suppliers may give you settlement discounts. If you're lucky, you may find some that do. And the question is, if you had a settlement discount that was due on, say, the 19th of April, and you were going to be paying the supplier on the 20th, would you take the settlement discount? Chances are you might give it a try. If it was the 18th that the settlement discount was due, would you take it? You probably would. If we came back to the 1st of April, roughly 3 weeks before we're looking at paying the supplier, chances are we wouldn't. That would be a bad April Fool's joke. So somewhere in there is a window of opportunity for you to possibly push the envelope with your supplier if they're offering you a settlement discount. In my case, I'm not going to be playing that game. My suppliers are fairly strict with me and they don't offer me settlement discounts, so I'll simply nominate the 20th of the 4th. So in other words, unless something is due on or before that particular date, I'm not going to take any settlement discounts. In terms of optional vouchers, these are vouchers, once more, exactly the same as with domestic supply, that aren't actually due now. However, if I was to pay them now, or pay them typically on that date of the 20th of the 4th, there would be a discount associated with them. Once more, probably unlikely that you would get discount terms from overseas suppliers, but not unheard of. So you might be looking and interested in any supplier that is offering you settlement discounts that were due on or before the 20th of the 4th, let's say, but in terms of the window of time, we might be interested in going back to, say, the 15th of the 4th. So in other words, things that had a discount associated with them if they were paid at some time between the 15th and the 20th of April, we'd like to include on this report, simply because if we pay them in that period of time, there is a discount associated with it. As I said, probably unlikely, but for the sake of this illustration, it won't hurt. The entity group we're doing, the system will assume all entities, in other words, a centralized administration scenario. If, however, your setup is such that each branch, cost center, division is responsible for paying its own overseas suppliers, then you can obviously limit that down to the appropriate group of entities. The report itself is run for a particular currency, one currency at a time. I might be interested in US dollars. The report can be sorted by supplier number or alpha key. I'm quite happy just to leave it at code. And I don't want to include discounts on my credits, which effectively would reduce the value of it. Here it comes back down to looking at why the credit was raised and whether you got discount terms and so forth. If you tick this box, it could reduce the value of the credit, and I certainly don't want to do that. So I'll leave it unticked. In terms of the control accounts, once more, you run the report for individual control accounts. Actually, I think it's APDJ something or other. Hang on, APDJ. I should know my US dollar bank control account. That's it. So if I just run this report now, we'll just drop it out to the screen rather than a hard copy, because I believe I'm only going to get a single report. Oh no, I actually have nothing within those dates. So great, nothing due now. However, I think if I was to put different parameters in, if I was to make that say the 30th of the 4th, 30th of the 4th, we might not be interested in those at all. Once more, if we look at US dollars, control account, DJAP, whatever it happened to be, run the report, out to screen, and this time I would expect we'll actually find some invoices that are due for payment. So yeah, at the moment I've got a single supplier with total value that I need to pay him of $18,712 for my Mr. Overseas supplier. These are the invoices involved. So what I will do at this stage is exit from here. Now, if I was actually using the Overseas Cash Requirements Report, which you don't need to use if you don't want to, I'm going to say you can do the same sort of thing with trial balances, or you can do the same sort of thing as what I'm going to do now. I have relatively few overseas suppliers. I know that I have to pay this guy now, in inverted commas, so I could just come straight into my draft voucher selection, say I'm going to do a payment run for, or a payment, an overseas draft payment for my overseas supplier. I would nominate the bank account that I'm going to draw this from, and this bank account, obviously, or remember, is actually an Australian dollar bank account. I'll talk briefly about what you would do if you have bank accounts in, say, US dollars that you wish to use for payment. But for the time being, we'll just keep it to the scenario that we don't have an overseas bank account that we're going to use. We're just going to buy the currency in the spot market. The voucher or vouchers that I'm paying, if we just use our select screen, we'd probably be paying some of these older ones first. So just select the voucher. The system will calculate the discounts and so forth that are due. If we had situations, I think I saw an open payment down there. So this particular voucher here was an open payment. That's where we've actually made a payment on account to the person, and it hasn't actually been applied to an individual invoice. It may have been that the supplier wanted payment for goods before they would actually ship them because it was a new supplier. So effectively I'm simply rolling that open payment up and applying it to this individual invoice, and we can just keep on going here for as many invoices as we had. Now, once more, the nature of the beast is that you probably don't have that many overseas suppliers that you're going to be paying, or that many invoices. It obviously depends on the supplier, and every business is different. But let's say that's it, I just need to pay these 3 invoices, or more specifically I want to pay these 2 invoices but also take this open payment into account. Now, I don't know whether your business deals with foreign exchange contracts at all, where you purchase overseas currency at a particular value and lock that in for a period of time. If you do, then you would have previously maintained your overseas contracts, purchased them. You would have, in this case, I've got a contract 1230 which I've purchased from the bank. It's for US dollars. It's for 10,000 US dollars, and I got a really good exchange rate of $1.10, which of course is most unlikely these days, but that was the exchange rate that's been locked in. So what I'll do here, because if I'm referencing that particular foreign exchange contract, this is my spot rate, was 92 cents, but because I've actually referenced that contract, the system is going to lock that exchange rate in and won't let me change it. If you don't use foreign exchange contracts, then leave the field blank, and you can nominate the actual exchange rate that you're going to be paying. Now, once more, you would normally be contacting the bank beforehand if you don't have the overseas facility directly, and you would say, can you please give me a price to buy $3,897 US, inclusive of your fees and so forth, and they would tell you, yes, you need to write us out a cheque, the Australian equivalent, just based on the exchange rate here, would be $4,199.99. But of course, the bank will probably ask you to write a cheque closer to $4,283.17. The difference between the figure that we're actually paying and the figure they wanted is of course going to be in bank charges. Now it could be that the bank has actually charged a bank interest or a fee or whatever on this as well. We may have had to pay $41.99 as a percentage commission. The system will go and deduct that from the bank charges because the bank interest component will be separate to the actual bank charges themselves. Now, of course, as I said, we're doing this transaction from a local bank. If we're wandering down to the bank and going to be handing over a check number, we'd record the check number in here that we'd be writing out by hand. If we're actually going to be transferring the money with an electronic transfer following the directions the bank have given us, then we'd put our TT reference in and we'd be recording this through the banking system. The date that we're actually going to be processing this at, and in my case, let's say that we'd like it to be processed tomorrow, please. So I'll put in tomorrow's date, and we simply save at this stage. Now, what that's done, it's flagged on the system. If we just come out and do an edit list, the edit list will allow us to look at the transactions that we've entered to date. So what we've done here in our edit list, we've recorded an overseas draft payment that we're going to be making. It's going to be paying those two invoices, taking up that open payment. These are the amounts that are actually involved. We've had to write a check for $4,283.17. That's it from the edit list. That's fine. Time passes, not much in this case. We're actually going to post our overseas draft, wander down to the bank, give them the money, or ring up our relationship manager and say, look, we've transferred that to the area you'd like, and you please take care of our suppliers for us. When we do the post process, the system will update the general ledger, the creditors system, and so forth immediately. So if we were to go to our accounts payable now, back and do an inquiry on Mr. Overseas Supplier, we'll see that we have our payment stuck in here, TT6271, for our $3,897, which are US dollars at this particular time. And of course, the usual inquiry facilities are available to us from the accounts payable system. So we can click on that voucher, we can see what the other vouchers were that were physically being paid, we can click on them and call details up if we needed to, and so forth. So the full inquiry facilities are there. But that's it. We've now gone through the process of paying our overseas supplier with an overseas draft. Just be aware that it's only, or it is at the time where we fully expunge our overseas debt, or our debt in a foreign currency, that the system is in a position to recognise any foreign exchange gains or losses you've made. These come about because, let's say if you were importing goods, you've imported goods, and on the day that you bought it in, you assumed the exchange rate was going to be 90 cents in the dollar. So every Australian dollar is going to be buying you 90 cents US. You would bring the goods into your system based on that exchange rate. Time passes, let's say it's 6 weeks from when you bought the goods in to when you actually have to pay the overseas supplier. The Australian dollar has improved, and at the day that you're actually doing your draft payment, your overseas draft to pay the supplier, the exchange rate might be 92 cents in the dollar. So in Australian dollar terms, you would need to be paying the supplier less. The difference between the original guesstimate as to your liability and the actual liability that you paid is a real foreign exchange gain at this stage. For example, if we're talking about $10,000 US, we originally thought that we were going to be having to bring that in at $11,000 Australian, but when we actually had to pay it, it would be closer to $10,970 or something similar. So we've got a $30 gain that we've made there because of currency fluctuations. If the exchange rates were flipped, then obviously rather than a gain, we'd make a loss. Now, you'll remember that those are the general ledger accounts that we set up on the currencies and so forth in the first place. Now, the only other thing I said I'd mention is if you actually keep a bank account in a foreign currency like US dollars, what you would do in that case to actually draw down that US dollar amount is in your bank reconciliation system, in the transactions, overseas draft payment through the accounts payable system has to draw from an Australian dollar bank account. But what we can do is a funds transfer. Now what the funds transfer would allow us to do is we can put a reference in, say, it doesn't really matter what the reference is, it's just for our internal purpose, the date, the bank account we're actually drawing from, and these bank accounts, I'm not sure if I have any of these. There we go, we have a US dollar bank account. That's the current exchange rate. So if I was actually paying, I think it was 3,700 and, well, let's say it's $3,700. That'll do for the purpose of this exercise. So if I was actually drawing $3,700 US out, I would transfer that into my main bank account. I believe the one I was using was my MK bank account. System applies that exchange rate for the amount, so $4,017.37. If there were bank charges associated with this, we could also nominate the bank charges, but in our case it's not if we're actually going to be transferring the money out of that overseas facility. So we're going to increase, when we actually save this bank transfer, I'll just copy that, we're going to increase the balance in our MK account by that amount of money. So we'll actually just go and do our post now and update the system. And that's going to reduce the amount of money in the overseas bank account and increase the amount in MK. Now if we just go and have a look at that physical bank account, if we look at MK100, which is where we transferred the money to, probably help if we looked at the right financial year, we'll see here this is where the money has actually come in from our overseas draft, being a total funds transfer of $4,017.37. Now, armed with that, after having transferred the money into this account, then when I did my accounts payable drafts payment, as a straight entry in here, what I would do is, okay, so we'll nominate the supplier. All I'd do is make sure that the exchange, or the amount that I was actually paying here, that check amount actually agreed, and I'd use the same exchange rate as I had used for my transfer, so there would be no bank charges and no bank fees and so forth. So that's the trick, as it were, to processing a payment for an overseas supplier if you actually do carry funds in bank accounts other than your native currency. So that's it. Dealing with overseas suppliers is quick and easy, and paying them is a straightforward process with Visage. Thanks for watching.